Thank you, Sarah. I'm Frank Duplashan, the Senior Business Development Specialist here at TShack, and here's a little bit about me and my background. I'm a former banker who absolutely loves to save money, and one of the things that drew me to not only working at TShack, but wanting to use TShack to buy my home was this program, the Mortgage Credit Certificate Program. It's one of my favorite things to talk about here at TShack, and I can't wait to tell you everything I know. This program is an annual income tax credit with no maximum value. That means that our program, if you're familiar with the MCC programs of the past, some MCC programs have a max credit amount of $2,000 where ours does not. This program is only available when you're using our non-bond DPA programs or our no DPA program. We're not allowed to get this mortgage credit certificate program by itself. And it's available to first-time homebuyers only, which is waived for people purchasing homes in targeted areas or people who are considered qualified veterans. With this program, another great thing about it is it builds upon the money you can save by acting as a tax credit and also supplementing as a tax deduction as well when you file your taxes. So when you're filing your taxes at the end of the year, this program allows you to take a credit on the interest you've paid on your home to receive a larger refund. Or possibly if you're self-employed or owe every year, it can lower how much money you would owe. If you have anything left over on that interest, you also get to deduct it as well. So it works on both ends as a tax credit and a tax deduction, really saving people money at the end of the day. So just to clear up what is considered a first-time home buyer, the true definition of a first-time home buyer is someone who in the last 3 years has not had ownership in a primary residence, nor resided primarily in a residence they own. This definition means you can still qualify even if you've owned a home in the past, as long as you haven't owned a primary residence in the last 3 years. A great example of this would be someone who's inherited a home, or someone who had lived in a home in the past, but has been renting it out in the past 3 years, and maybe they've been renting an apartment. Currently, TShack's MCC or Mortgage Credit Certificate credit rate is 15%. This 15% credit rate means that home buyers will receive 15% of their mortgage interest back every year that they're living in their homes. That effectively means they're receiving a 15% discount on the interest they pay for up to 30 years. On tshack.org, next to the loan comparison calculator, you'll find the MCC savings calculator. Please use this calculator to show your clients the full benefit of an MCC. During the conversation, you should stress the fact that they can claim the MCC credit for 30 years, even if they happen to refinance. Now that we've shown that the MCC can have a 30-year benefit by using that mortgage credit certificate savings calculator, it's time to talk up to your clients about how a mortgage credit certificate can impact their mortgage interest rate. So if one of your clients was applying for a mortgage and the rate that they were approved for is 6.5 because they were using one of our down payment assistance programs, they would have the ability to add an MCC to that because they're a first-time home buyer and using a TShack down payment assistance program. So if they're eligible for the mortgage credit certificate, the program would provide a 15% reduction of the interest they pay in the form of a rebate when they file their federal income taxes. So what this means for your client is that they've effectively had their mortgage rate lowered to 5.525. The mortgage note rate, the mortgage monthly payments, and the approval for the mortgage will still all show a 6.5% interest rate because that is the daily rate at that time. However, your client will be able to receive a 15% rebate on their tax returns of the mortgage interest they paid for the full year. So that means that their effective rate has been lowered to 5.525. In every area surrounding this mortgage credit certificate, you see benefits and savings, but one of the main things that you want to point out to your clients is that you have a way to effectively help them lower their interest rate. And as I said earlier, even if you refinance, and somehow end up with a lower rate than what's used in the example, you'll still be able to use that MCC to get that 15% rebate in the future. Now that we've talked about how a mortgage credit certificate can affect someone receiving down payment assistance, let's talk about how, if your clients are receiving our no DPA program, how the mortgage credit certificate can still have added benefits. So, TSHAC's no DPA program does not provide down payment assistance. However, it does offer a lower market rate interest rate for a mortgage, whether you're doing a conventional or government loan, meaning FHA, VA, or USDA. So, in this example, if you were to have gotten our FHA no DPA loan, the down payment required would still be 3.5%. However, if you were to add an MCC to that file, you'll also be able to give your home buyer the benefit of a 15% tax credit or rebate on the interest they pay on their home. And if we go over our previous calculations, we'll show that that takes their effective interest rate down, what they're actually paying, down to 4.887. So, of course, their mortgage and their loan application will still be based on that 5.75. But because of the mortgage credit certificate, you're still effectively lowering their interest by 15%. And once you see that effective rate, you'll see that this is one of those programs that I love telling realtors and lenders about to help them retain business. If you see that you may have clients going to another lender because they're offering a lower interest rate, or maybe going to a different realtor because they're offering access to programs that you weren't quite too familiar with, this is a great way to not only retain business but earn new business by advertising that you now know how to get people access to a 15% rebate on the interest they pay on their home for 30 years. In this example, we're going to go over how to calculate the added benefit of a mortgage credit certificate without using the calculator on our website. So in this example, the home buyer's loan amount is $300,000. The interest rate we were able to get them is 6.5%. So what this means is that at the end of 12 months, so at the end of a year, they would have paid $19,500 total in interest on their home in their first year living there. If this person has a mortgage credit certificate and they're getting the benefit of that 15% credit rate, that would add up to $2,925 of a rebate that they would get back. In this case, if you're self-employed, this means that you'd be able to lower how much you owe at the end of the year on your federal income tax return by $2,925. And even if you're currently getting a refund, this would possibly increase your refund by $2,925 as well. So this is another one of those reasons why I love this program, especially if you love saving money. To build on that added benefit that the mortgage credit certificate provides, loan officers are able to take the $2,925 granted as a credit in that first year of your home buyer living in the home and divide that by 12 months and add that in as income on a loan application. So even though the client is just now buying the home, a loan officer can still use this mortgage credit certificate to calculate the rebate they would receive in their first year and add it as income on a loan application. This qualifying income does not count against the home buyer when they're using our programs. So you never want to worry about this extra monthly or annual income pushing anyone over our income limits. It's not an issue. Increasing the amount of money that the homebuyer makes by using this program and using it as income on your loan application, there increases the homebuyer's buying power. So if they need a little bit extra in income to afford the home they're looking at, adding an MCC may be the solution. Adding MCC income on your loan application also lowers the home buyer's debt to income ratio. So if you're a realtor and you're speaking with your loan officer and they mention that the home buyer has a high DTI ratio and it's hard for them to get the loan approved, it's always worth mentioning and reminding the loan officer, hey, have you tried the mortgage credit certificate program? The income from an MCC may help lower the DTI enough for you to get a loan approval. While we're on the subject of mortgage credit certificates and federal income tax credits, let's talk about how tax refunds actually work. Let's say we have Sally here, and based on how much money Sally earns a year, her tax liability, or technically what she owes to the IRS, happens to be $10,000. And Sally is a W 2 employee, so every time Sally gets paid every 2 weeks, Sally uses her payroll income tax withholding to cover how much is owed. But what ends up happening at the end of the year is after Sally is putting away money every 2 weeks, every time she gets paid to cover her liability, she ends up putting away too much money, and then we end up with a refund. Now let's take the same example with Sally, and let's just assume Sally was able to work with you as a realtor and one of our preferred loan officers to get the mortgage credit certificate program as well. So if Sally has a mortgage credit certificate, nothing would change. She'd still be working her W 2 job, and every time she was paid, she would have money go into the bucket to cover how much is owed. But at a certain point in time, the MCC comes in, and let's just say at the end of the year, when Sally's filing her taxes, and the MCC will come in and knock Sally's liability down from $10,000 to $7,075, which is effectively what a mortgage credit certificate is doing. So every 2 weeks, when Sally gets paid, she's still putting money in to cover her overall liability, but because of an MCC, she ends up with more money outside of that bucket, increasing her refund by $2,925. So this is one of my favorite benefits and ways to show a home buyer or any kind of client that you're working with how the MCC can benefit them every single year. Now that we've covered all of the benefits for the mortgage credit certificate program, let's talk about some of the things to note. Each homeowner is responsible for filing their mortgage credit certificate on their federal income taxes every single year that they live in their home as a primary residence. If you're filing by hand or paper, you'd fill out Form 8396. Otherwise, if you're filing online, your online tax preparer will apply the mortgage credit certificate to your taxes every single year. All home buyers are provided a recapture tax notice when they're using the mortgage credit certificate program. And recapture tax happens if a home buyer sells a home within 9 years and makes a net profit on the sale, and their income increases 5% over their county income limit each year they've lived in their home. So you must do all three of those things to ever pay anything back to the IRS for this program. And it happens on less than 2% of the mortgage credit certificates we offer, so it's rare. If your home buyer ever has any questions about it, or if you have any clients that have any questions, please ask them to email us at homeownership@tsahc.org. MCC holders may claim remaining interest, property taxes, and whatnot as a deduction. So even though you get a credit on 15% of the interest you used, you get to use the remaining 85% of that interest as a deduction, so it doesn't go away. Lastly, you have to be earning taxable income for a mortgage credit certificate to have a benefit for you when you're filing your federal income taxes. If you do not pay taxes on the income you earn, maybe you're on SSI, military disability, maybe you're only being paid in annuity payments, the MCC program will not have an actual physical benefit for you. So please make sure your clients consult with their loan officers to make sure that when you review their tax returns, they actually will have a benefit for using the MCC program. Lastly, here are some very, very important marketing tips when you're talking about the mortgage credit certificate program with your clients. Please take note of people that you've helped in the past that received a mortgage credit certificate. I always joke and say it's perfect and reasonable for you to call them every single January and remind them that you were the realtor or the loan officer or the underwriter or the title person that told them about the mortgage credit certificate program and you made sure they knew about it, which is why they have it. So don't forget to come to me next time you're looking to buy a home, sell a home, upgrade, you name it. All right. So please make sure you take note of whoever you help get an MCC and make sure you reach out to them every year and tell them to claim it. Send an email through your list as well. You don't have to physically call people, but if you'd like to set up a reminder email to just automatically remind them, hey, it's February 10th, it's February 15th, it's tax season, don't forget to file your MCC. Please make sure if you're going to include the tax form in your email that you go to irs.gov and you download the most up-to-date 8396 form. It should have the most up-to-date year on it as well. Lastly, if you're calling your home buyers or you're reaching out to them and telling them to file and they've lost a copy of their physical mortgage credit certificate that we mailed them, it's no big deal. You can be the go-between to reach out to TSHAC, give us a full list of all the home buyers that are missing one, or if it's just one person, email us or call us and provide their address and their phone number or email address, and we'll go ahead and send another copy out to them. But you can be that expert, that representative that bridges the gap between you, your client, and TSHAC and the Mortgage Credit Certificate Program. So thank you guys for joining me today. And now I'll pass it off to my favorite person at TSHAC, Kayla Gillespie.